Good morning and welcome to the Business Compass series of webinars, this time on family investment companies and wealth planning. The aim of today is really targeted at those mid to high net worth individuals and families and associated advisors who are considering ways of mitigating inheritance tax issues and associated tax issues. We're going to be covering a wide range of matters. I think as a starting point, I want to emphasise, obviously, my name is Richard Coulthard. I'm a director at Iceland Harrison Solicitors and I head up the corporate and commercial teams. I'm not a tax advisor specifically, and quite a lot of what we're going to be talking about involves some fairly complicated tax issues. So typically where this advice is being given, it's being given in conjunction with tax advisors at the same time, often done in partnership because there's a complex range of both tax and legal issues to consider whenever estate planning and associated matters. Of course, we had the budget on the 30th of October 2024, and that's also made some changes around business property relief. Previously, well, certainly up to April 2025, if you owned shares in a trading business at the point of death, then in most situations that would qualify for business property relief, meaning that you wouldn't be paying any inheritance tax on the value of those shares. That has, however, changed, and that relief now only accounts for 50% of the value of the shares in that trading business, which means you'd be paying an effective rate of tax of about 20% on the value of the shares in a trading business. This will mean that there'll be further estate planning required because the estate's going to have to find the value of that money to pay the value of the shares, or 20% of the value of the shares. And it may lead to further planning work that might be required in terms of pre-death tax planning and things like that. And part of that process may well be considering something along the lines of a family investment company, group companies, and we're going to consider some of the options that might be available around that in terms of looking at what is an investment asset and what is a trading asset. Trading businesses also qualify for a better rate of taxation on inheritance tax than you would do through an investment company. But we'll look at some of the different options that might come in connection with that. Today, I'll talk at a very high level about principles. It's important to emphasize that what is the correct advice depends on personal circumstances of the individuals involved. You know, are they married? Have they got children? Age, type of assets they own. Is it property? Is it other investments? Is it trading businesses? There's not a one-size-fits-all solution. So this is very much about talking in general terms about principles, rather than any specific advice based on individual specific circumstances. So firstly, let's look at what actually is a family investment company, a FIC for short. Well, family investment company is typically a mechanism by which families, ordinarily starting with parents or grandparents or what have you, looked to distribute wealth amongst family members and limiting the value of their own estate moving forward. And it's done within the context of a company, because this allows some great flexibility about how we can deal with the shares in that company, including things like freezing the value of shares, or putting growth shares in place, dividend-only shares or non-voting shares. Broadly speaking, the idea being that a family or parents will set up a new company more commonly, but it's a new company, and parents will probably invest funds in that business, potentially as a director's loan. And this is quite common in property, for example. But the parents in this scenario probably don't want the value of their estate to ultimately increase. They don't want to accumulate any more capital wealth, because all that's happening is that's creating a long-term inheritance tax issue. So what would typically happen, for example, is the parents in this scenario would have a certain class of share for which we would look to freeze the value. We would say the capital value of those shares doesn't increase beyond the current value. But it still entitles them to dividends. It still entitles them to withdraw their director's loan, for example. That would be withdrawn tax-free, of course. But then we normally have a separate class of shares for children or grandchildren, which are potentially what we call growth shares. The value of any growth in the business is attributable solely to the shares owned by the children. The benefit of this mechanism is that you are limiting the value of the parent shares, the grandparent shares, or whoever it is that's estate planning, and making sure that all capital growth belongs to the children. So if you look at this in the context of, let's say, a property investment company, for example, you can have a situation whereby the parents introduce the initial capital as a director's loan. So if they've got wealth, maybe from a sale of a business or from other assets or something like that, they can introduce that money into their property investment business as a director's loan. So let's say they invest £1 million into the property investment company. That's a loan, so for the company that is a liability. It's money that the parents are still entitled to have back, so it's money that they can still draw on, but it's a liability within the business. And we can set up the shareholding in such a way whereby the parents might only obtain some of the capital value or none of the capital value of the growth of the business. So the company uses that £1 million, for argument's sake, to buy properties, for which at that point, when they're acquired, will probably have little additional capital value, because obviously the liability owed to the parents for the monies that they've put into the business. The growth in the value of those properties, however, if they're being refurbished or even if they're just being held as investment purposes, that's all being passed to the children. So it's a good way for there to be a building of family wealth without necessarily increasing the parents' individual capital value and therefore inheritance tax that's associated with that. So, as I said, the individual circumstances need to be considered on a matter-by-matter basis. It may well be that something like this is considered in conjunction with trusts. So you could set up a discretionary trust or something like that, whereby the beneficiaries of the trust are a class of persons. So it could be children, grandchildren, and so forth, successors. It could be set up for a particular purpose, rather than identifying individual shareholders. And that can also have some holdover relief, things like that, which we'll come on to. So it doesn't necessarily need to be considered in isolation. But there could be significant tax benefits as this long term. One of the other things to consider is whether this needs to be part of a group of companies, which I'll come on to in terms of whether there's trading companies and investment companies, because of the different taxation rules that come into play when it comes to inheritance tax. The overriding point of this, however, is that this is part of a wider strategy regarding estate planning. Family investment company might be just one of a number of options that may be considered. And you may have multiple family investment companies as well. So it could be that you have an investment company that is strictly for property, as in, real estate, commercial premises, things like that. You could have a separate family investment company that invests in stocks and shares, trading businesses, whiskey barrels, whatever other sort of investments that you're looking for. It does depend on the nature of the investments that you're looking at. But the important thing and the mechanism that this allows you to have is a situation that avoids parents, grandparents, or what have you, increasing the value of their overall wealth, their capital value, and that actually reserving that capital growth to children or other family members, but still allows the parents to draw an income, which can sometimes be one of the main questions if you've got elderly members of the family who still want to have an income out of these investments, to pay for their lifestyle, or could be to pay for care or what have you, and we can create the structure that allows that, whether that's as dividends or maybe redrawing the director's loan or repaying the director's loan, which has already been invested, for which they can withdraw tax-free. So we talked about group companies. So you can have a group of companies that you divide into for different purposes, and there's a number of reasons you might want to consider doing this. For instance, in respect of property, you might want to have a separate construction arm or something like that that might be registered for VAT purposes, for example, so that you can get some release on there. So you could have a group of company, one that potentially holds property, for example. You can have another company within the group that is a construction company and actually provides construction services not just to the family but on a wider basis. But that might, become VAT registered, for example, so you get some relief around VAT. There might be other businesses in the group that are trading businesses, and we've already talked about the advantage that gives you from business property relief standpoint, albeit that isn't as advantageous as it used to be. But actually, even if you're going to sell the business during a lifetime of a person, a trading business subject to other rules might qualify for business asset disposal relief, which would allow you a discounted rate of tax, currently 10% on the first £1 million, albeit that increases to 14% from April 2025, and then 18% from April 2026. And that's on the first £1 million per seller. It's still a better rate of tax than your general capital gains tax rate, which are obviously increasing in the same period. So, but that only applies to trading businesses. It wouldn't apply to an investment business. So thought needs to be given to the overriding group structure and the individual aims and the people involved in different situations. We've had families that we've advised, for example, where there's one child, for instance, who is actively involved in the business, running the business, whether that's a trading business or investment business, and other siblings who are more passive. And parents have to then combine the fact that broadly their starting point is most probably that they want their estate to be split equally. But that's to be combined with the challenge of saying, well, actually, this particular child might be running the business, and therefore, should they get a bigger share, or how is that compensated? Now, that could be done through salary. It could be done through a higher capital value of the shares in the particular business or businesses that they're running, whereas personal assets, personal home or something like that, might be split in a greater weighting to the children who are not involved in the business. This is all requiring planning. One of the advantages that you can have in respect of group structures is that it can allow for intercompany loans, for example. You can dividend money up to the holding company without a tax charge, and you can manage the finances of the businesses, or the finances of the families, I should say, at a holding company level, which can make it a little bit simpler. But there are a number of considerations there, because obviously it can also impact your corporation tax position in terms of what rate of corporation tax. So some careful tax planning work needs to be given. But group companies can offer you huge advantages in terms of actually making sure that you're getting the right reliefs available according to the position of the business. As said, expert tax advice is required on a case-by-case basis. One of the questions that we do get asked is, can minors have shares? So can children under the age of 18 hold shares? Technically, they can, is the starting point. There's no law preventing them from holding the shares. In practice, it can be complicated, however, particularly when it comes to decision making. The general law around children and contracts is a question of whether it's a contract for necessity, and therefore can they make a valid decision, for example, if they have to vote on a decision to be made within a business. So, for example, if you needed to pass a resolution in the business and you had minors holding a significant proportion of shares, there is a technical question as to whether they can vote on that decision. And if they can't vote on that decision, then can that resolution be passed? The point that I make in a general sense is if you've got minors who you want to have shareholding in the business, I would suggest that either they need to be older minors, so 16, 17 years old, what have you, probably have a minority stake in the business. If you've got younger children or a more broad class of children, then you might want to consider whether it is preferable to put it into a trust. The children could still be beneficiaries of that trust, so they're ultimately the ones that derive the benefit, but you would have adult trustees who would be the parties authorised to make the legal decisions around that. There are some other considerations, don't get me wrong, in terms of how trusts are taxed and what have you, but it might be a safer way of ultimately passing down the long-term benefit to the children without necessarily the short-term complications around decision making. Again, depends on the individual circumstances to consider. Trusts and wills. Now, we're talking about estate planning here, and the issue around companies and company assets is just one part of that. More often than not, of course, individuals who have significant value in companies will probably have significant value in personal assets. So whether that's the family home, for example, it could be personal investments, it could be personal property. All of this planning needs to be done holistically around the full estate, not necessarily just company assets. All individuals should have a will is a starting point. A will is the basic mechanism by which the estate is distributed, and will include by nature some basic tax planning that comes within that. For instance, passing assets amongst between spouses, for example, things like that, but also just making sure that the wishes of the individual are actually met. So everyone really should have a will. Trusts add some additional benefits potentially. They're not right for everybody, and I am aware that some people can be quite reticent about trusts. They might have heard concerns about how trusts have been managed or trusts have been charged, for example. You need to look at what the individual circumstances are. One of the benefits often for trusts, however, is you can claim what is known as holdover relief. So if you're transferring certain assets into trust, you may be able to hold over the gain, capital gain. Whereas if you sold a property, for example, privately, the capital gain on that would be payable within a short period of that sale. But in certain circumstances, if that same property was transferred into a trust, you would potentially be able to what we call hold over that capital gain. That doesn't mean that capital gain disappears. It's just a relief that may be available to mean that you don't have to pay that capital gain on transferring that property into the trust, for example, and that tax isn't actually payable until that asset comes out of the trust, which it may never happen. One thing to bear in mind, there are relatively recent rules around trust registration, which means that the vast majority of trusts now need to be registered with HMRC, and it is unlawful not to do so. So it is important that you do get your trusts registered. If you've got historic trusts that haven't been registered, you may need to register those as well. I'm not personally a trust expert. We have a wide number of solicitors in the firm who are experts in trusts and wills, who would be able to offer more detailed advice on that. And typically, where we have high net worth individuals who are advising in situations such as this, the advice typically is delivered by 3 professionals. You have the tax advisor dealing with the overall tax strategy. You would have someone such as myself dealing with the corporate structures and making sure all the relevant agreements are in place, or whether we look at things like cross option agreements, for example, so that if a shareholder passes away, is that an insured loss that pays out the value of the shares? and that might be particularly relevant now with the changes around business property relief, for example. So you could potentially insure the tax liability that arises on the passing of an individual who owns shares in a trading business. So that's an important point not to overlook, that you do need to plan for that. So that potentially is where someone such as myself would come in. And then you would normally have the wills and trusts lawyer involved, in conjunction with the tax advisor and corporate lawyer, to look at actually the wider estate planning piece. But also, as we said, whether we look at putting some of the shares in the companies, for example, within a trust environment and trust wrapper, so as to benefit a class of people rather than an individual person. One of the areas that we've done a fair bit of work over the last few years, which broadly links into this, is around what we broadly term to be educational trusts. So it's where typically grandparents are setting up a trust, or acquiring shares in a trading business potentially run by parents, and putting those shares into trust for the benefit of grandchildren and so forth, to help pay for private school fees or other matters of educational importance. And that can be done essentially as a dividend out of the trading business into the trust to pay for those school fees, for example, rather than a parent, for example, having to pay for that out of their net income, which will have been taxed, most probably dividend tax rates, or otherwise. There has been some tightening up on rules around this from HMRC, so again, expert advice is required, but there is a mechanism there potentially to enable the payment of private school fees or associated tuition costs and what have you, through an education trust, which would have some of the shares in the family investment company or trading business or something like that. So that should need some thought. I've talked a bit earlier on about property portfolios, and this can often be one of the more tricky issues to be thinking about. We quite often see situations where parents or grandparents or what have you have been investing in properties for a number of years, and quite often those properties are held in different legal structures. Some may be in a private personal name, some might be in a partnership, some might be in a limited company, and these have all got different taxation rules, and it can sometimes be difficult to move these properties around. The biggest issue typically is going to be capital gains tax, and so thought needs to be given as to whether there has been a gain or whether there's anything you can claim against that gain. For example, have you done any renovation work to the property, and things like that. The other consideration then is inheritance tax, and sometimes there needs to be a careful consideration as to actually what's the better time to be thinking about paying that tax. Are you better paying capital gains tax, which potentially is a lower rate than what the inheritance tax position would be? Moving properties around tends to be a little bit more difficult, but there are some options available depending on value of the properties when they were purchased. Is there lending against the properties, things like that. So some of the considerations may be, for people who have got unincorporated property portfolios in a single name, is whether you've got the grounds to create a property partnership, so potentially gifting some of the equity in some of the properties to children or other family members with a view of creating a partnership. And in the certain situations, if that's a genuine business rather than an investment, so if you've got a reasonable sized portfolio that you actively manage, actively renovate and refurbish, you might be able to seek relief on incorporation around the capital gains if that is a trading business rather than an investment vehicle. It's quite a complex issue, this. It's not a straightforward. Individual circumstances need to be taken into account and an expert advice needs to be taken, but in the right situation it might be that you can look to go from being a partnership potentially through to a limited liability partnership, but potentially through to a limited company. In some situations, you could maybe go from a property partnership to a limited company directly, but you might be able to claim incorporation relief in the right circumstances for this. Also, as part of the long-term strategy, use your gift release. How much can you gift before it falls out of your estate after 7 years, and that decreases over a sliding scale during that period. Now, that might still trigger a capital gains tax issue, but actually you've got annual allowances that you might be able to utilize to gift equity in the property over a period of time, provided you've got the time to plan for this. Another option is whether you essentially sell the properties. So if you've got properties in a personal name, you could sell them to a FIC, to a family investment company. And one example of this that we recently utilised, we had an individual had an investment property, for example. Let's say it was worth £300,000 for argument's sake. They also had cash available to them of £300,000. Now, they had a couple of options. They could have gifted £300,000 to the children. For example, the children could then loan that money to a new company, which would then buy the property. The benefit of that is parent is gifted £300,000 worth of cash. That's outside of their estate. The children have invested that money as a director's loan into the company. So the children can extract that £300,000 tax-free at a future date because they've loaned it to the money to the company in the first place. The company then use that £300,000 to purchase the property from the parent. So the parent has lost £300,000 that they gifted in cash to the children, but they've also disposed of the property into the limited company as well. So the parent has reduced capital value of their estate in that scenario by £600,000. Yes, there will be some capital gains to pay on that, but from a capital value and inheritance tax planning perspective, they've reduced the value of the estate by £600,000. They could still have shares in the family investment company, which then owns the property, from which they could have an income, so they could take dividends, for example, to continue paying for their lifestyle. But they've reduced the capital value of the estate. The £300,000 cash gifted to the children is obviously subject to the 7-year rule around inheritance tax. But that's kind of an example of some of the creative ways that we can look at trying to mitigate inheritance tax liabilities. A lot of this, however, comes down to having the time to plan for this properly. Generally speaking, the later people are in life, the harder it is to do this sort of planning work. And what's the right planning work will ultimately depend on the individual circumstances, as I've already said. But with the right planning, it is possible to significantly mitigate the amount of tax that you may ultimately have to pay. Property is particularly complicated because of the rules around that, and that needs some particular thought and particular planning. Best advice actually is for those individuals who are, shall we say, emerging wealth. Their business is doing well, and they're, I don't know, in their 40s, something like that. And they've got younger children. Actually, starting that planning process at that stage can have huge benefits longer term. But I appreciate many people are not necessarily in that scenario. But leaving it till later in life, it can limit their options somewhat. I'm going to leave my contact details there on screen. As I've already emphasised in some detail, the right solution is based on the individual circumstances, and you need to take individual advice on a matter-by-matter basis. But there's plenty of options available to you, whether that's a family investment company, whether it's something like a property partnership, whether it's trusts, or whether it's a combination of all of those. There can be huge benefits. But the key takeaway is don't leave it till it's too late. The sooner you start planning for this, the better off you and your family will be in the longer term. And we can distinguish between the capital value and the underlying value of the assets and the right to income, because that's quite often one of the bigger questions is, oh, I still need that asset to have an income to pay for my lifestyle. Well, we can distinguish between the two. It just takes some careful planning work. But we're happy to help here at Ice Harrison Solicitors. We do this type of advice very regularly, and we work very closely with a number of tax advisors who can also add their knowledge, or with your own accountant and what have you. But these are specialist tax issues, so you need to be supported by that expertise. Thank you very much for listening today. I hope that's been insightful and a useful overview of what is quite a complicated topic. There's been a lot more to say on this, but we wanted to give a high-level overview. If you do want to speak further on it, please feel free to email me, and we can set up an initial meeting or call or what have you to discuss any individual circumstances. Thank you once again. This has been the Business Compass series of webinars, and hope to see you again soon.